Hello and welcome to the look ahead for Thursday, the 20th of March with me, Fiona Cincotta, Senior Market Analyst at City Index. So there's quite a lot going on today, but I think the main focus for us will be on the Bank of England interest rate decision. We do also have UK wage data, or labour market data, should I say, as well. But other things to be watching out for: Australian jobs data overnight, also German PPI inflation figures. SMB rate decision is also expected. And then in the US session, we've got jobless claims and existing home sales. So just kicking off with the Bank of England, not expected to cut rates, expected to leave interest rates unchanged at 4.5% after cutting by 25 basis points in the previous meeting. A lot of attention will be on what obviously Bank of England Governor Andrew Bailey has to say, particularly given the changing outlook with regards to the global growth and Trump's trade policies and what that means for the UK economy. Now, the meeting comes at a time when inflation has ticked higher to 3.3%, and at the same time growth in the UK has also contracted. We've seen growth ease to 0.1% contraction month on month in January. So basically this puts the UK in a bit of a difficult situation of a sort of stagflationary outlook. Inflation is expected to continue rising as well to 3.7% in Q3 as a peak. So the growth, as I said, is looking rather weak. Labour market data will be coming out beforehand. Now, interestingly, the wage growth is an area that's going to be watched quite closely. Now, wage growth has been really sticky, and that's intrinsically tied to service sector inflation, which has also been sticky. Sorry, I say wage growth has been strong rather than sticky. But interestingly, there has been a survey released today, an industry survey, which suggests that employers are bringing back wage growth, or pay increases in line with inflation. And this really comes at a time ahead of a lot of nervousness with regards to companies and costs as far as staffing costs are concerned, given that we have the increase in the minimum wage, which is coming through in April, and we also have the increased burden on employers for the national insurance contribution. So going to see hiring, I think, starting to slow considerably. That could potentially also see an impact on wages. So, I mean, that's what we're going to be watching for. As I said, Bank of England not expected to move. It'll be very much based on the commentary surrounding Bank of England Governor Andrew Bailey. Now, this is the pound US dollar. The pound has rallied really quite well from that low of 121 that we saw at the beginning of January, touching these levels here, which is the 130 key psychological level that the price is struggling to push beyond. We've also got the RSI, which is sort of, teetering on the brink of overbought territory. It's sort of been in and out of overbought territory over the past couple of the last couple of weeks. So, I mean, we might find that 130 level is just right now too much of a barrier for the price to be able to push above. Obviously, buyers do need to get above that level in order to get to the 130.50 level. But as I said, given this RSI, it seems that we may struggle to get there. On the downside, immediate support down at 129. That's the psychological level. Then we've got 128.50, which is last week's low. Ahead of the 200 SMA at 127.85. So we could potentially see some consolidation in this range, in this area, which is a range that has been familiar in previous instances. So that's what's going on with sterling. Also, as far as the FTSE is concerned, just worth pointing out that the market is pricing in a couple of rate cuts by the Bank of England this year, potentially with the next one in June time, May-June area. So this is the FTSE. We've obviously seen the rally to that all-time high at the beginning of March. Since then, we saw that rebound lower down to a low of 84.60. Recovered higher, hasn't managed to push above that rising trend line that we've been sort of looking for a rise above. Seems to be struggling at that resistance around the 87.35 level, which was also the high that we saw last week. So we haven't pushed above last week's high. The RSI is still above 50, but not convincingly. So, I mean, if we do find that the Bank of England is rather cautious about the outlook for the UK economy with regards to sticky inflation and slowing growth, then we might actually find that that sort of weighs on sort of house builders, retailers, in the FTSE. However, it's also worth bearing in mind that the FTSE is made up of plenty of international stocks who benefit from a weaker a weaker pound. So if we do find that there is any movement in the pound that sort of weakens the pound, then we could find that that is beneficial for the FTSE. But that's the level I'll be watching on the upside. It's around the 87.50 level in order to get to the 88.100. On the downside, immediate support around here at the 86.15. That was the low that we saw at the end of February. That's also the 50 SMA. If we get a break below that, then that's just going to bring that 84.90 level, which was 84.80 level. Sorry, that was the high that we saw back in May last year. Also mentioned, we do have US data. Jobless claims expected to tick a little bit higher to 224,000, up from 220. Nothing major. And we are seeing, obviously, we've got the Federal Reserve interest rate decision hasn't taken place at the time of recording this video, will be taking place. Not expected to see the Fed cut rates. However, a lot of attention is going to be on forward projections, as well as the dot plot for clues over how the Fed sees the outlook for the US economy under this Trump regime of trade tariffs and trade wars, which are expected to be inflationary and could cause a slowdown in the economy, putting again the US in that difficult sort of stagflationary zone. But so this is the US dollar, Japanese yen. Japanese yen, we saw the Bank of Japan leave interest rates on hold last night. The Bank of Japan did suggest that wage growth and data are sort of in line with expectations of continued rate hikes. However, there's a lot of uncertainty surrounding the global growth outlook and what the impact that could be of Trump trade tariffs on Japan and the Japanese economy. So that's weak. We've actually seen the yen weaken following the meeting, despite the fact that the Bank of Japan, is expected to hike rates again, although the timing surrounding that is unclear. Now, we have seen a recovery in the US dollar, as I've said, ahead of the Fed. So that's sort of helping the recovery of the US dollar, Japanese yen from that 5-month low of 146.50, just testing the upper bound of that falling channel. The longer term downtrend, the medium term downtrend of a negative trend is still in play. We would really need to see a sort of a rise above here, which is around the 141.55 level and the 200 SMA, in order for us to consider that the chart is negated the downward trend and is pushing higher. On the downside, immediate support, this is the level to be watching out for, 148.60. That's the low that we saw back in December. If we get a break below that, that's going to bring this level in here at the 147 level, which is the level which we can see is it's the 61.8% fib retracement level, but it's also a level that's been important back in September last year. Below that, we'll get a lower low, opening the door towards 145. I guess the other one to keep in mind whilst we're looking at US data, obviously let's not forget that there are concerns over that slowdown in the US and what that means for US stocks. Obviously, we've seen a very steep sell-off in stocks over the past 3 weeks. Do seem to see a sort of a bit of a bottoming out, but I wouldn't say there's any major signals on this chart that suggest that the downtrend is reversing. For now, I mean, we need to get a rise above this, the 19,950, that was this week's high, in order to create a higher high and expose the 200 SMA at 20,330. However, on the downside, a break below the 19,300 level could create a lower low bringing 19,000 into focus. So, as I said, I think the Fed this evening is going to be a big cause of, or could direct trade as far as the NASDAQ is concerned. And then US jobs data tomorrow will also be in focus. So that is everything from me. I hope you've liked the video. And if you have, then please do give this video a like. And if you'd like to see more videos like it, then please do subscribe.